our 4,700 target implies some degree of soft landing in the underlying economic circumstance. We know that we've got Fed tightening ahead. Talked about this earlier this week. We were looking for 450 basis point moves consecutively over the coming months. We've got one in addition to the 25 basis points in March. So it's still premature to say how the Fed activity is going to ultimately impact underlying economic conditions. Earnings growth remains strong and has been a positive story through all of this. So I'd say what is critical here is that you do get the Fed moving back towards a neutral policy benchmark, which most people think is in the 2 to 2.5% Fed funds range. If we can get there with some slowdown in earnings, but again, soft landing type earnings, then I think there's still a path forward to the upside from here. We've been most focused in navigating this volatility by playing themes such as quality from a factor perspective, those companies that have some built-in inflation resistance, if you will, that also have strong balance sheets and sort of strong profitability characteristics as well. But what I would just point out here is that I think what we're looking at in our work anyway is a recession scenario, mild recession scenario, which in our view would take us down to say 3650. When you look at the risk from here to that level versus the upside to our soft landing end of the year target, you can see where the market is kind of between, but the further down we go, the more gets priced in regarding recession fears, which I think we think sets up for some relief as the year unfolds.
Well, I think it was a mixed report. The payroll number was somewhat stronger than we had expected, but I think the maybe more important developments are unemployment rates stable, employment to population ratio a little bit lower, the U6 rate a little bit higher. So I think there is some evidence that the labor market is stabilizing, and the wage numbers have decelerated over the last several months. We were running at 6% plus on an annualized sort of sequential basis for much of the second half of last year. We're now running at 4% or a little bit less. That's still higher than what is ultimately consistent with 2% inflation. So I think it underscores that the Fed, definitely has a significant amount of work to do, but we're moving in a more encouraging direction, I think.
It's been very painful, and I think it's clear that not only is our equity markets really nervous and edgy, but they're hyper sensitive to inflationary data. And I think, whether it's FOMC meeting or even today's payroll numbers, it's really about getting some comfort that inflation's breaking. And from our perspective, it's been really painful. And I don't want to sound like I'm trying to be stubborn, but I just think the risk reward for equities here has improved this week. And I know it sounds glib to say, well, it's, everything's 5% lower, that's why you like it. But number one, on the FANG trade, I just think that multiples are still becoming gifts, especially if we have a soft landing or even a recession, because these companies can grow through a recession. But I think people are overlooking things that are actually forward indicators, because today, for instance, the Manheim Used Vehicle Index came out. It's down to a year-over-year growth rate of only 8%. It was 24% last month. Believe it or not, that in 2 months might take out half a point out of CPI. So I'm kind of more in the camp now that I think we can get some softer readings on CPI. It's not necessarily in the hard data yet, but when it does, I think that's when stocks can really find their footing.